From equity concentration risk to political instability, are investors underprepared for uncertainty? Joining me today is John Davey. He's CIO at Astoria Portfolio Advisors, along with Todd Rosenbluth. He's head of research at VettaFi. What a day to have you all with us here today. Let's just get started. John, tariffs, the talk of the markets, the talk probably of the globe. Of course, one of the major criticisms is that they can spur inflation. But you believe that's just the tip of the inflation iceberg, and it's a bigger risk right now, actually, than most portfolios are prepared for. What do you mean? What about more so than beyond what's happening today?
Well, the last 2 years we've had this mega cap concentration rally in just 7 stocks, and that's driven like the S&P and the Nasdaq 100 higher. So most advisors that we talk to still want to own growth, and they're very apprehensive about owning other sectors and themes, sectors that benefit from higher inflation. So, core PCE, which is the Fed's preferred measure of inflation, is 2.6. The goal is 2%, so we're still structurally higher. And, tariffs that are announced over the weekend, tariffs by nature are inflationary, so prices will go up. And, I think investors' portfolios should begin to allocate towards these real asset sectors.
Yeah, obviously a lot of puts and takes and discussions about what's going on today, and things seem to be moving a little bit with timelines at the very least. But Todd, what's your assessment of inflation risk in the coming year, so beyond this week?
Well, I think advisors aren't really thinking of it. We at VettaFi recently did a survey of what the key risks for many advisors have top of mind, and geopolitical and downside in the equity markets was more top of mind than inflation. I think inflation moved to the back burner for many investors and advisors. But we do think it is a concern. If there are tariffs and if they stick, and that's a big if, then that's going to be inflationary. Prices are going to rise for many goods, and that's likely not something that advisors, investors are fully aware of and prepared for.
And obviously we're already sitting at pretty high price levels, at least when you compare sort of a core basket of goods at the very least to what we're looking at 2019. So you're talking on top of that. John, you run an inflation adjusting fund. How exactly does that work? Why might that be a good idea for someone concerned about rising inflation?
Sure. So we look at the sectors that historically have benefited from higher inflation. So that would be like energy, industrial, material stocks. And we really pick, the highest quality stocks within those sectors. So we launched the fund in December 2021. And if you were to pull up a chart of PPI, our fund, versus S&P, the vast majority of the last 3 years, we have been beating the S&P, which is very difficult and very rare to have something that doesn't use leverage or complicated derivative products. So at the end of the day, these are value-ish sectors, and there is some idiosyncrasies within these sectors, which is that there's a buyer's strike because we have been living in the last 3 years of structurally higher inflation. And then more recently, we have added like data centers, power plays, which again is another idiosyncratic story that's looking to benefit from like the AI theme. But still, at the end of the day, these data centers and power plays are, real assets. So, the fund has a 13 P ratio, still pretty cheap. S&P Mag 7 is, 20. It's very expensive, right? The S&P, it's 22.5 on forward earnings, which is, 10-year highs. So, we like it as a portfolio diversifier.
So obviously, Todd, there are other inflation-fighting funds out there. We let John sort of talk about the one that he offers. How are they looking, sort of the other options for inflation-fighting funds?
Right, so PPI is distinct versus some of the other products that are out there because it's multi-asset. So Horizon Kinetics has an ETF, the ticker is INFL. It's the Horizon Kinetics Inflationary Beneficiary ETF, I believe is the full name. And INFL offers just exposure to the stocks that management believes can outperform in an inflationary environment. They're asset-light strategies. Whereas we have some funds, the Fidelity has a stocks for inflation ETF. The ticker is FCPI, Frank CPI. That ETF is more diversified across the sectors in that space. And you can see how FCPI, it's a bit more technology focused than perhaps the PPI product that John's talking about, and that's why its track record has been better in the more recent past. We'll see what happens going forward. And then the third fund that comes to mind is Van Eck has a real assets ETF, RAAX. is the ticker on that one. And this is VanEck's own ETFs. It's an ETF of ETFs that can give you exposure to some of the industries and sectors that VanEck believes can perform well in an inflationary environment.